Imagine you had invested just $500 a month starting at age 25. You did not pick any special stocks. You did not watch the market every day. You did not hire an expensive financial advisor. You simply put $500 into one single investment every single month and completely forgot about it. By the time you turned 65, that $500 a month would have grown to over $3.24 million. From $240,000 in total contributions into $3.24 million. That is not magic. That is not luck. That is the S&P 500, and today I am going to teach you exactly what it is, how it works, and how you can start investing in it today, even if you are a complete beginner with zero experience. Welcome back to Rich Habits, the channel where we make investing so simple that even a 10-year-old can understand it. If you are new here, subscribe right now and hit the notification bell because this video could be the most important financial education you have ever received. Let us start from the very beginning. What is the S&P 500? Let me explain the S&P 500 in the simplest way possible. Imagine your city has 500 of the biggest, most successful businesses. There is a bakery, a car dealership, a hospital, a tech company, a supermarket, and 495 more. All of them are hugely successful. All of them are making money every year. Now imagine someone comes to you and says, instead of putting all your money into just one business, what if you could own a tiny piece of all 500 of them at once? That is exactly what the S&P 500 is. The S&P 500, which stands for Standard & Poor's 500, is a list of the 500 largest publicly traded companies in the United States of America. We are talking about Apple, Microsoft, Amazon, Google, Nvidia, Coca-Cola, Johnson & Johnson, JP Chase, Walmart, and nearly 500 other corporate giants. Some of the most successful businesses ever created, all wrapped into one simple investment. When you invest in the S&P 500, you are not betting on one company. You are betting on the entire American economy. And for over 100 years, that has been one of the best bets anyone could make. Think of it like this. Instead of buying one apple and hoping it is the best apple in the market, you buy a basket containing all 500 apples. If one apple goes bad, the other 499 protect you. That protection is called diversification, and it is the foundation of smart investing. The track record that speaks for itself. Now let me show you why the S&P 500 is considered the greatest wealth-building tool in human history. Over the last 50 years, the S&P 500 has returned an average of 11.71% per year. Over the last 30 years, it has returned an average of 10.12% per year. And over the last 20 years, which includes the 2008 financial crisis and the COVID-19 crash, it has returned an average of 11.84% per year. Here is the most powerful statistic of all. Every single rolling 20-year period in S&P 500 history has been positive. That means no matter when you started investing, before the Great Depression, before World War II, before the 2008 crash, if you stayed invested for 20 years, you made money. Every single time. The worst 20-year return in history was 6% per year. The best was 17% per year. The average lands around 10% to 11%. Now compare that to leaving your money in a regular bank savings account, earning 0.38% per year, which is the current national average in America. On $10,000 over 30 years, regular savings account at 0.38% equals $11,200 at 10% average equals $174,000, same money. Same 30 years. 15 times more wealth just by choosing the right vehicle. Part 3, Index Funds and ETFs, how you actually buy the S&P 500. Now here is something that confuses a lot of beginners. You cannot go to a stock exchange and simply buy the S&P 500. The S&P 500 is an index. It is a list, a measurement, a scorecard. You cannot buy the scorecard itself. What you buy instead is called an index fund or an ETF, and this is how ordinary investors get access to all 500 companies at once. An index fund is a pool of money managed by a company that automatically buys all 500 stocks in the S&P 500 in the exact right proportions. When you invest $100 into an S&P 500 index fund, that $100 is automatically spread across all 500 companies, and you own a tiny piece of Apple, a tiny piece of Microsoft, a tiny piece of Amazon, all at once. An ETF, which stands for Exchange Traded Fund, works almost exactly the same way, but trades on the stock market like a regular stock throughout the day, making it flexible and easy to buy and sell. Here are the best S&P 500 index funds and ETFs available right now in 2026. If you're ready to invest in the S&P 500, you have several excellent options. Some of the most popular funds include Fidelity's FXAX, Vanguard's VOO, iShares IVV, Schwab's SPARSP, and Fidelity's FNILX. The important thing to understand is that all of these funds are designed to do essentially the same thing: track the performance of the 500 largest companies in America. That means whether you choose Fidelity, Vanguard, Schwab, or iShares, you're still investing in the same group of companies. The biggest difference between them is the expense ratio, which is simply the small annual fee charged to manage the fund. For beginners, one of the best options is Fidelity's 500 Index Fund, FXAISK. It has an extremely low expense ratio of just 0.015%, requires no minimum investment, and charges no trading fees. To put that into perspective, if you invested $10,000, your annual fee would be only about $1.50 per year, less than the cost of a cup of coffee. The key takeaway is this: don't spend weeks trying to find the perfect S&P 500 fund. The differences between these funds are tiny. What matters most is choosing a low-cost fund, investing consistently, and staying invested for the long term. That's where the real wealth is built. All of these track the exact same 500 companies. The only difference is the annual fee called the expense ratio. Part 4. The account you need to start. Before you can invest, you need to open the right type of account. This is where many beginners get confused, so let me make it crystal clear. There are 3 main account types for investing in the S&P 500. 1. Roth IRA. The best account for most Americans. A Roth IRA is a retirement account where your money grows 100% tax-free. You invest money that has already been taxed, and every dollar of growth, every dollar of dividend, every dollar of profit comes out completely tax-free in retirement. In 2026, you can contribute up to $7,000 per year into a Roth IRA. This is the single best account for most Americans building long-term wealth. 2. 401k. Free money from your employer. If your employer offers a 401k, especially with matching contributions, this is money you cannot afford to leave on the table. If your employer matches 50% of your contributions up to 6% of your salary, that is an instant 50% return before you even invest a single dollar. Always contribute enough to get the full employer match first. 3. Regular brokerage account. No limits and no lock-in. A regular brokerage account has no contribution limits and no restrictions on when you can withdraw. You pay taxes on your gains, but it gives you complete flexibility. The order of priority. First, contribute to your 401k up to the employer match. Second, max out your Roth IRA at $7,000 per year. Third, invest any additional money in a regular brokerage account. Part 5. How to open your account and buy your first S&P 500 fund. Here is the exact step-by-step process. It takes less than 30 minutes. Step 1. Choose your platform. For beginners in 2026, the best platforms are Fidelity. Best overall for beginners, no fees, great tools. Vanguard. Excellent for long-term investors. Charles Schwab. Great customer service and no minimums. Robinhood. Simple app, good for very first-time investors. Step 2. Open your account. Go to the platform's website. Click Open an Account. Choose either a Roth IRA or a regular brokerage account. You will need your social security number, your bank account details, and a government ID. The whole process takes about 10 to 15 minutes. Step 3. Fund your account. Link your bank account. Transfer the amount you want to invest. Most platforms allow transfers of as little as $1. There is no minimum to start with Fidelity or Robinhood. Step 4. Search for your fund. In the search bar, type the ticker symbol of your chosen fund. For Fidelity, type FXAIX. For Vanguard, type VOO. Step 5. Buy your shares. Click Buy. Choose the dollar amount you want to invest. Click Confirm. That is it. You are now an investor in 500 of the biggest companies in America. Step 6. Set up automatic contributions. This is the most important step most people skip. Set up an automatic monthly investment, even if it is just $50 or $100 per month. This strategy is called dollar cost averaging, and it means you buy more shares when prices are low and fewer when prices are high, automatically smoothing out your returns over time. Part 6. The most common beginner mistakes. Now that you know how to invest, let me warn you about the mistakes that cost beginners thousands of dollars. Mistake number 1. Panic selling when the market drops. The market will crash. It always has. It always will. The 2008 financial crisis wiped out 50% of the S&P 500. COVID wiped out 34% in weeks. Both times, the market fully recovered and went on to reach new all-time highs. The investors who sold during the panic locked in their losses forever. The investors who stayed in or bought more made a fortune. Mistake number 2, trying to time the market. Countless studies confirm that even professional fund managers cannot consistently predict when the market will go up or down. Do not try to be smarter than the market. Just stay in it. Mistake number 3, checking your portfolio every day. Watching your investment go up and down daily is the fastest way to make emotional decisions that hurt your returns. Check your portfolio once a month at most. Once a quarter is even better. Mistake number 4, choosing the expensive fund. On a $100,000 investment over 30 years, the gap between FXAX at 0.015% and SPY at 0.095% is roughly $2,900 in lost returns, just from fees. Choose the lowest cost fund. Always. Mistake number 5, waiting for the perfect moment to start. There is no perfect moment. The best time to start was yesterday. The second best time is right now. Every month you delay costs you compound growth you can never recover. The simple investing blueprint. Here is everything you need to do. Summarized in 5 simple steps. 1. Open a Fidelity or Vanguard account. Roth IRA. If possible, regular brokerage otherwise. 2. Buy FXAX or VOO. The lowest cost S&P 500 funds available. 3. Set up automatic monthly contributions. Even $50 or $100 per month. Reinvest all dividends automatically. Let compounding do its work. Do not touch it. Review once a year. Ignore the daily noise that is the entire strategy. No complexity. No guesswork. No stress. Warren Buffett, the greatest investor in human history, has said on multiple occasions that when he dies, he wants 90% of his wife's inheritance invested in a low-cost S&P 500 index fund. Not individual stocks, not hedge funds, not real estate. A simple low-cost S&P 500 index fund. If that strategy is good enough for the greatest investor alive, it is more than good enough for the rest of us. Start today. Start small. Stay consistent. And let time do the rest. If this video helped you understand investing for the first time, please give it a thumbs up. It truly helps this channel reach more people who need this information. Share it with someone who has been putting off investing. And subscribe to Rich Habits so you never miss a video. See you in the next one.